Alright folks, yeah, this is going to seem like a little bit of a Tesla FUD-ish video, but the purpose of this video is not to spread FUD, it's to address fear, uncertainty, and doubt, because I'm a big believer that if you're investing in a stock and you hear something that's FUD-ish, the worst thing you could do is stick your head in the sand and pretend it doesn't exist, because you'd be blind, and then you get blindsided and rug pulled, and that's bad. You have to be aware of new information and be able to address it head on. So, according to Bloomberg Intelligence, Volkswagen is set to overtake Tesla in 2024 for global electric vehicle sales. It already beats Tesla in Europe now. Take a look at this chart. Folks, I have to say, when I first saw this, I was not very happy. Volkswagen has substantially more models than Tesla does. Volkswagen also is in a position where they can sell cheaper models than Tesla. However, Volkswagen does not have the margin, they don't have the autopilot or self-driving, and they don't have the profitability or growth that Tesla has. See, Volkswagen is expected to grow 4 to 6% per year over the next 5 years, with negative earnings likely, that is year over year, losses, or like declines, I should say, not negative implying losses, but like declines in earnings by 2026. This means that even though Bloomberg thinks that Volkswagen is going to overtake Tesla in number of vehicles sold, they actually think their net revenue, or I should say their net income, the earnings per share, will actually be negative year over year by 2026. This is likely because, in my opinion, Volkswagen is going to really try hard to compete with Tesla by slapping as many batteries into cars as they can, but they're going to completely fail at actually providing a loyal customer experience and the most frontier-style technology, like full self-driving technology, in a seamless manner. And so, yeah, when I first saw the Bloomberg chart with those EV sales from Volkswagen, I kind of thought to myself, damn, that kind of sucks. Like, I want Tesla to be the number one. But then I got to thinking to myself, you know what? It wouldn't surprise me, though, for a company like Volkswagen to just slap together as many EVs as possible, sell electric vehicles to more of the older generations or even women who don't like Teslas as much as guys do. And the reason I say that is not to be ageist or sexist, it's just a fact. The average Tesla purchaser, first of all, has a median household income of $140,000 to $150,000, substantially higher, like 2x higher than the Volkswagen median household income. But in addition to that, we also have mostly males who are between the ages of 25 and 45 driving Teslas. So, when we consider like the relative market cap of Tesla versus all of the other legacy autos, yeah, it's pretty large. I mean, we're like 6 to 7x Toyota, okay? It's a lot. But why is the Tesla market cap like this? Because we're expecting a potential 50% annual compounded growth rate. Now, if Tesla misses on this growth rate, we're going to have big problems, and Tesla's valuation will get squeezed down. However, one of the reasons that Tesla also has the valuation it does is because we expect the nearly 90+% margin FSD revenue to become a big driver of massive EPS growth over the next 10 years. And this EPS growth from full self-driving has not been properly estimated by Wall Street yet, or quite frankly anybody yet, because the fact of the matter is, nobody knows. Now, it's also worth noting that Elon Musk just tweeted that right-handed Model Ys were substantially underproduced because they underestimated the demand for Teslas in the United Kingdom. Now, I then found a separate chart that I thought was incredibly fascinating. The largest amount of competition to Teslas isn't from generic everyday driving brands like Hondas, Hyundais, Toyotas, and I'm not trying to offend anybody by saying this is generic, just not premium brands, right? The biggest competition for Tesla actually comes from premium brands. And the biggest leading sales, that is countries with the biggest amount of premium brand sales, are actually Germany and the United Kingdom. But first, a quick shout out to our sponsor and a thank you today to Upstart. High interest credit card debt is really bad, but how bad is it? Well, let's say you owe $3,000 at 23% in 10 years, your debt would accrue to almost $24,000. That is an 8x. Don't let the credit card companies steal you for an 8x. And this is why it's so important to consolidate your credit card debt or debt in general to a lower rate as early as possible. It's crucial. Thankfully, Upstart's powered personal loans can help you pay down high-interest debt all online with a simple and easy-to-understand payment structure and clear and simple payment terms. Upstart has already helped 1.8 million people pay off credit cards, consolidate high-interest rate debt, or fund personal expenses. Once you get your loan with Upstart, Upstart lets you pay it back in one fixed monthly payment with a clear payoff date. Upstart knows you're more than just a credit score, which is why they look at other factors like income, employment, and other information provided in your loan application to find you a smarter rate for your loan, because you are more than just a number. You can check your rate in minutes for loans between $1,000 to $50,000 without impacting your credit score. You can even receive funds as fast as one business day after accepting your loan. So don't wait. Check your rate today with upstart.com/Kevin. That's upstart.com/Kevin to check your rate today. Don't forget to use our URL so that way you can let them know that Kevin sent you. Go to upstart.com/Kevin. Get this. Almost 1/3 or 31% of all cars sold in Germany and the United Kingdom are considered premium vehicles. In the United States, only 12% of vehicles are considered premium vehicles. Now, this is also a little bit of a downside because of, well, the dollar is getting substantially stronger, making Teslas more expensive, even more expensive. And Germany and the United Kingdom are much more likely to be in a deeper recession or a recession than the United States is. Like, if the United States is in a recession, Germany and the UK are probably going to be in a worse recession. You see what I'm saying? A little bit of a downside. It's kind of like, yeah, we have Chinese buyers of Teslas as well, and they're in a worse situation than America is, right? These are concerns. But that actually means that we don't need to be so potentially worried about EV sales from Volkswagen cannibalizing Teslas. We've got to be more worried about BMW, Audi, and Mercedes. But let's be real. From what I've seen from even just Volkswagen, I'm not at all remotely concerned about the competition. Please, have more people get, like, their EV cherry popped, so to speak, with a Volkswagen, and then let them compare their EV Volkswagen to a Tesla and go, oh, damn, I made a mistake. Like, really, one of the biggest competitors for EVs is not EVs. It's actually ICE cars, internal combustion engine cars, gas cars, right? That's where the competition is going to come from. So, folks, we do have another little bit of bad news. And no, it's not that there's a coupon code expiring at the end of next week for the programs on building your wealth, especially through real estate or long-term building your wealth with strategies that are very, very smart to follow for long-term investments. Take a look at all those programs on building your wealth, link down below. But folks, it is the bad news that we have some layoffs that are finally coming through. In fact, we have a collection of LinkedIn posts that are showing that project leads, CGI animation leads, one person who was working at Tesla for 6.5 years, have been cut. The manager of Singapore has been cut. Staff trainers have been cut. Regional warehouse managers have been cut. And 3 hiring events in China have been canceled. This is all part of the start of Tesla's 10,000 layoffs. And based on LinkedIn posts, we're starting to see them come through. Now, it's unfortunate, but this is part of the way that I believe Tesla will maintain their margins by trimming the fat. And I hate to say that phrase because it sounds so terrible, because these are individual people with lives and who have dedicated themselves to Tesla, and now they're getting the boot. My heart goes out to them. But looking at a company going into a recession, it's unfortunately what has to happen. And I think that's why every single one of us needs to look at our income and our wealth or our jobs and realize we're not immune to getting cut or having our incomes go down either. Now, the NHTSA, obviously, the National Highway Transportation Safety Administration, is upgrading its probe into 830,000 Tesla vehicles now because of the ADAS systems, advanced driver assistance systems, which have led to some accidents. This, unfortunately, is an expansion of the original crash investigations by this organization, and I think that is relatively fuddish. I don't really have much of a comment here because every time I've looked into these crashes, like specifically that crash in Texas where there was no driver in the front in a car with full self-driving, it ended up being user error. Now, there are cases where Tesla's full self-driving has led to accidents and deaths, so I'm not trying to give Tesla a complete pass here. And would I get into FSD and trust it blindly? Absolutely not, because I've seen the car do some stupid stuff too. Then again, it's still a computer, it's learning. We just hope we don't get any kind of crazy regulation out of the government because of this. Right now, the biggest lobbies for regulation against Tesla are actually competitors for vision technology and driving technology. Like, the most common ad you see on TV right now bashing on Tesla's full self-driving is funded by a company that does their own computer vision and like radar sales and hardware. And it's like, this is so slimy and shady. I hate it. But anyway, folks, listen. The only way Tesla can get back to $1,000 and then get to $2,000 and $3,000, and you need to know this if you're an FSD or if you're a Tesla investor, is through the massive and rapid expansion of earnings per share. Not the PE, well, not like multiples, okay, because multiples are compressing all around us. It's what happens in a recession. Earnings per share need to explode. That's it. Thanks so much for watching, folks. Check out the programs on Building Your Wealth, link down below with the coupon code expiring at the end of next week, and we'll see you in the next one. Goodbye.